Hey everybody, my name is Justin, and today I want to talk about my favorite three stocks that are in the market that I think have really good value going into July 2023. In this first video, watch to mine. Again, my name is Justin. I am a value investor. You can see all these books behind me. So I try to tailor my investing strategies after Warren Buffett, Howard Marks. I also took Phil Town's investing course a couple of years ago where I learned a ton. I've read all three of his books, and I just try to use all this information that I have learned over the last several years to really try to strategize what works for me. But I do follow a lot of what Phil Town talks about in the four M's: the meaning, the moat, management, and margin of safety. So we're going to talk about all three of these stocks. I'm going to give you my valuation on all three of these stocks, and make sure you're doing your own research. It's not a recommendation to buy any of these stocks. This is how I personally feel. These are my opinions. So let's just dig right into this. All right, so the first stock I want to talk about today is Advanced Auto Parts, ticker symbol AAP. Most people are going to recognize this company right off the bat. We'll talk more about what they do and what they are in a second. But if we take a look at a stock chart over the last year, you can see that it has been absolutely hammered. Over $200 a share if we go back about a year ago, right at the end of August 2022. Today it's trading at around $70. So that is a 60% fall over the last year. In fact, in June, it collapsed from around 140, 130, something like that, down to mid 60s at one point. So definitely has been crushed. Here recently as well. Now, what do they do? Again, most people probably know this business. They are an auto parts store. So the AutoZone, O'Reilly's, Advanced Auto, those are kind of the big three companies in the United States, and certainly Advanced Auto is one of those. In fact, out of the three, I actually frequently visit Advanced Auto Parts more than those other three companies, or other two companies in general. So in 2022, they did about $11 billion in sales. They have 50 distribution centers. They have almost 5,000 stores. In fact, this year they're projected to add about 40 to 60 new stores. 1,300 of those are independent stores. So most of what they have are corporate stores, but they do have a good chunk, so almost a third that are independent. And then 644 hubs, super hubs, and branches overall. We continue to talk about them. Some of their brands you probably recognize. So CarQuest is a big one of theirs. WorldPac, Auto Part International. I don't know those two as well. Certainly Die Hard is one of those. I actually just bought a new battery for my truck, and I went there and got a Die Hard battery. So I think CarQuest and Die Hard are good brands that are out in the market in general. Now, if we take a look at some catalysts for this company, I think over the next year or two, some things that will help drive the business. The chip shortages that have been, we've been seeing over the last year or two have really constrained new vehicle sales, and new vehicle sales or new vehicles in general, the prices have just shot up. I think about 30%. Over the last couple of years, which is the largest in history. So most people, or a lot of people, are holding on to their cars longer. In fact, the average car is 12 years old. The average annual mileage for people that are driving continues to rise year over year. So the average used to be 12,000. Somewhere now it's in the $15,000 to $16,000 mileage per year. So that's going up. People are just driving more. And then inflationary environments limit spending. So people have less money because of inflation, buying groceries and other needs. So I think it's pivoting folks to perform their own car repairs, and that's me included. I just replace my own battery. I replace the spark plugs on my truck. I do my own oil changes, and so to me, it's hard to stomach going to Grease Monkey or other places and dropping $130 for an oil change on my truck when I can do it myself for $50 or whatever. So I do think there's some catalysts for this industry and for this company. Now, financial metrics. This is interesting because there's not a really good trend here. So if you're familiar with Phil Town, a guy that I talked about previously in this video that I follow very closely, he's kind of got the big five numbers, the sales per share, earnings per share, free cash flow per share, book value per share, return on invested capital. So this section right here. So this can be a good, these are good metrics to look at and look at a trend on a 3-year, 5-year, 7-year, and 10-year basis. Kind of see how the company's doing. And unfortunately, certainly over the last couple of years, we've actually seen them slow down. Now, keep in mind, 2020, 2021, I think this industry in general saw a huge surge in sales. So with people staying home, I think they were working on their cars, putting money into their cars. And so you can kind of see in 2020 and 21 that they had some tick ups just in general. But what is concerning is over even a 10-year basis, their earnings per share has only grown 2% per year. Book value per share grown about 8%. However, the last 5 years, it's down 2%. This past 12 months, the free cash flow per share is actually negative. That's why these numbers are all kind of bombing out on me down here. Obviously, that's not a good thing. Not a good thing is their debt has increased. So their debt equity, I like to see under 100%, preferably around 75% and less. And right now it's 176%. So their debt has gone up compared to the equity. We'll talk more a little bit about their debt here in a second. Now, as far as a multiple that the market has paid for this company over the last 10 years, on average, it's been around the 16. Last 3, it's been around the 17. Another concerning thing about them is that their operating margins, have not necessarily taken a beating, but they used to be around 11, 10%. And then over the last several years, they kind of been in that 6 to 8% range. And that's where they were projecting, at least the company was, for this upcoming year. But one of the reasons why their stock tanked in June is that they put a new forecast out with the revenue dropping, and which means that that's going to flow to earnings and free cash flow as well and hurt some more of these metrics. But as a business, they actually have not performed as well as much as their peers, which we'll talk about here in a second as well. So risks with this business, competition, certainly. I talked about O'Reilly's. I talked about AutoZone. These are companies that kind of all do the same thing. Yeah, they may have their own brands or whatever, but they pretty much offer the same thing. It's a very saturated market. So I don't think there's a huge moat. I think the Advanced Auto has really unimpressive margins. If you look at O'Reilly's, AutoZone, their gross margins are in over 50%. Advanced Auto is around like 45%. The operating margin for Advanced Auto are around 6 to 8%, while the competitors are in the 15 to 20% range. So obviously that's not good. Their debt has grown. However, the maturity dates are not a concern. They're far out into the future. And my guess is they'll continue pushing those out. So debt in general, I'm not going to say I'm not concerned with it, but as far as maturity dates, nothing short term is a concern. Another concern is continued dividend reduction. They recently reduced their dividend. If they continue to do that, that will hurt the stock price going forward. Now, as far as a valuation for this company, this is what I think. This is a discounted operating earnings model that I've created. And basically what I'm saying here is that I think they're only going to grow on the top line 2% over the next several years. That is it. So about $11 billion sales last year, and they're only going to get to about $12.5 billion in 2027. So not much growth overall. Operating margins will be around the 6% range. The company wants to get up to 8%. I'm keeping conservative, saying 6%. I'm using a multiple of 16. I could easily use a multiple of 17, 18. That's where they've been at historically. But again, conservative. And so I come with a share price of $100 for this company. It's a 33%, margin of safety. And obviously there is risk with this company, especially compared to their competitors. They're not as good. But when I look at Advanced Auto, even though that they don't perform as well as their competitors, from a valuation, from a stock price, it is really, really, there's just a lot of value there. And I do think that the market has beat them up too much. I think $130 a share is too much from which they're trading at, 6 weeks ago. But being around $65 to $70, my cost base is around 67 at this point. I just think it's a company and stock that's going to bounce back. I don't think it's going to be a world beater or anything like that, but it's just too darn cheap in my opinion. But again, always do your own research there. But that's what I think about Advanced Auto Parts. Next I want to talk about is M&T Bank, ticker symbol MTB. Over the last year, the stock is down about 20%. hasn't it's not as down as much as some other companies in the market right now, but banks in general just have been hurt tremendously over the last about 3 months, and M&T Bank certainly got pulled down with the rest of the banking market in general here recently. This is a top 15 U.S. based companies per market cap goes. So they are considered a regional bank, which is kind of interesting because they're in the Northeast, but they reach 25% of the entire population of the United States because it's so populated out where they're at. In fact, they own almost 1,000 branches in the Northeast. I think they're the third largest bank in the Northeast region. Kind of think of like New England, Boston type area, but they are in 12 different states, kind of in that region there. Right now they're around a $20 billion market cap. They're trading around roughly $120 a share at this time. They have seen some of their deposits drop a little bit, not too concerning against the industry average. They're kind of right there. In fact, they might be doing a little better than that. But it's a company that has really great management. In fact, the average tenure for their management is 19 years across the board, which is absolutely tremendous. They are not a bank that takes a lot of risk. The Silicon Bank that actually went bankrupt here in the last couple of months, they had a lot of risks. Management just did, in my personal opinion, very not necessarily less low integrity, but they just made really dumb decisions overall. And M&T Bank has been around for 100 plus years, and it's a company that has traditionally just stayed to its what it knows best and doesn't go out into the market and try to stretch their dollar. They just are hold themselves to high integrity, and they just keep doing what they're doing and not really worry about what the other banks are doing. In fact, if we take a look at what they do compared to their peers, and this is right out of one of their investor presentations, their tangible common equity is actually the best out of all their peer groups. Out of 12 banks in their group, they're at 7.6%. In fact, if you go back and look at their return on tangible common equity, over the last 2 decades, they've been close to around 20%. This is a bank that has really outperformed their peers and has been very, very consistent. In fact, they're only one of two banks in the S&P 500 that did not get rid of their dividends or lower their dividends during the financial crisis of 2008. So that speaks a lot of how well this business and this bank is run. Overall, 64% of their deposits are insured or collateralized. Average consumer deposit account balance is around $13,000. So they don't have a small customer base with huge dollar amounts like we saw with the Silicon Bank issue. So they have a lot of customers. So they're spread. They're very diverse, which is fantastic. Average business banking deposit account balance is around $47,000. Deposits spread across 12 states. We talked about that. Nearly 1,000 branches. They have the third largest or third highest number of branches in their area of all banks. Their average relationship tenure of 17 years with wealth customers, 16 years for consumers, 15 years for commercial, and 13 years for business banking. So their customers really like what they do, and they stick with them for a very, very long time, which I think goes to how well the bank is run overall. All right. So from a book value per share standpoint, if you look at last 10 years, their book value per share is the lowest it has been in 10 years. And in fact, the only other time it's been even close to that was back in March 2020 when the entire market collapsed. So this historically is about as low as they've ever been. So from that standpoint alone, the stock price looks really cheap. But if we dig into a little more and take a look at a different type of valuation, I'm not going to go into exactly how I calculate these numbers. I did that in another video, but I'm looking at return on assets, return on equity. I'm looking at the earnings yields of each of these banks, and then also looking at the book value per share to kind of come up with, I think, how much return I'm going to get on a per annual basis if I were to buy the stock right now. And so, for example, M&T Bank, I would expect to get around a 20% return for annualized on a CAGR basis going forward. Bank of America is around 13% on these metrics. JP Morgan Chase is 8%. And then Bank OZK, which is another regional bank. If you follow Phil Town, you'll probably recognize that one. That's on at 13%. So M&T Bank is by far the best out of the four. So I just wanted to kind of show you against their some of the competitors of other banks in their area where they kind of where they're valued at right now. So I think it looks really cheap based on the stock price right now. And it's one of those banks that Warren Buffett owned for a very, very long time. I don't think he owns it anymore, but he certainly owned it for a good amount of time. Third stock is Douglas Emmett. If you've been following me at all, I've talked about this company a lot. I continue to believe this company has a ton of value. Ticker symbol DEI. This is a company that the stock price has just been hammered over the last year, down 43%. It was up around $35, and now it's trading, I think today, around $13. At one point, it got almost all the way down to 10, but certainly a stock that has been hurt, and everybody in their industry has been hurt. This is a REIT. This is a company that owns a lot of properties, which we'll talk about here in a second. The industry in general has just been demolished over the last year. This is a company that really is in two main areas. It's in Los Angeles, and then it's also in Honolulu. So they own an office portfolio. So think of huge office type buildings, and most of that portfolio is in LA. I mean, you're talking only 3 properties in Honolulu, or there's 52 properties in the LA West Side, 16 in LA Valley. Now they do have multi-family homes that they lease or rent out as well, and that's kind of split between LA and Honolulu. And then as far as a combined portfolio, so total annual rent, most of it's come from the LA West Side, 65%, LA Valley is 24%, and then Honolulu is 11%, overall. So some catalysts, from Douglas Emmett that I see, they're in 2 of the top 5 GDP cities in the entire world. Los Angeles, Honolulu, there's a ton of money there. So I think they're in 2 really rich areas, which is great because they can actually charge higher rent. So I think that's a great catalyst for them. There's very little room for development in Los Angeles. I mean, Los Angeles is pretty much built out, right? So a competitor can't come in and just build a building right next to them and then start renting it out. There's really no room in Los Angeles, so that I think also helps Douglas Emmett going forward, not worrying about competitors moving into the space. And then historically, many of the large companies in the world have signed leases with Douglas Emmett. There's been a number of them out there. I mean, Square is one of those, and it goes on and on. But something that's hurt Douglas Emmett, and we'll talk more about the risks about this company here in a little bit. As far as some quick financial metrics on this, you can see, even though the company's been hurting over the last year from a stock price, they've continued to grow their revenue. So their revenue has grown from 600 million all the way up to almost 900 million. So even though we've seen a suppression in their stock price, and that we've seen a little bit of suppression in their operating earnings as well over the last, it's been kind of volatile over the last 6 years. But it's been, if you look over a 7-year period, they kind of been somewhat flat, but the revenue is still growing. But as far as risk go with them, their vacancies have increased, and this is across the board for their industry. So typically their vacancies are around 7-8%, and right now it's like 20%. Not good, right? So there's been a shift to work from home, obviously, with more companies wanting people to work from home, so maybe they don't need as much office space anymore. But also with the whole rates and rate increases, inflation, a lot of companies, there's a lot of unknowns, so they haven't renewed as much as their leases they had historically. So that's why REITs have just vastly underperformed the market over the last year. Look at REITs compared to the rest of the market in general. They're like the bottom of the barrel as far as where their stocks have gone. And also continued dividend reduction would hurt Douglas Emmett stock price in the future. Now, from a book value per share standpoint, over the last 10 years, this is the cheapest that it has ever been. Ever been. I mean, their average is around a 2.3, which is kind of like in this range right here. And right now they're trading below a 1. So from a book value per share standpoint, which is a good way on how to value, in my personal opinion, REITs because of the assets that they hold. They're not like a typical company that might be in the restaurant space or in the tech space. They really use their assets to generate income, and so a book value per share standpoint, which looks at equity, I think is a great way at trying to figure out the valuation. And right now, it just looks dirt cheap, but certainly risk with REITs in general. But I do think they eventually will bounce back. So based on a book value per share, I think there's a nearly a 50% margin of safety based on the current stock price right now for Douglas Emmett. All right, so those were the three stocks I wanted to talk about for July 2023. And again, that is Advanced Auto Parts, that is M&T Bank, and then that is Douglas Emmett. These are all companies that I think have some really, really good value in the market. Advanced Auto, I think, has around a 33% margin of safety. I think M&T Bank, based on the stock price right now, I think I'm going to earn around 20% per year on a return on investment from it. And then Douglas Emmett, I think, is around a 50% margin of safety. And like I said before, a couple different times in the video, these are just my assumptions, my opinions. If my assumptions are wrong, my valuations are wrong. So always do your own research. Don't just listen to someone on YouTube and go buy a stock. Do your own research. If you're interested on how to value stocks, I do offer different templates on my Patreon. If you're interested, I'll put a link down below. You also get access to my Discord channel as well. We have around 70, 80 value investors that are in there, and we talk about stocks, talk about the market, and all that kind of good stuff as well. So again, if you want to check it out, love to see you over there. Thank you so much for watching the video. I really appreciate it. I'll catch you guys on the other side. Take care, and God bless.